Do you think another recession is coming around the corner? Or are we, what are your thoughts on just the general economy? Because it relates a lot to how we are lending on properties, at least last time around it did. Got way out of hand, and the criteria was just too lax. And then post Great Recession, I think the lenders overcorrected, and now they're largely moving back into balance again. And of course, here we're talking more about homeowners, home buyers, owner occupied properties than we are investment properties. But this all relates to the entire banking system and the entire real estate market, and that's why it's important to discuss, even for investors that are buying $140,000 houses in the Midwest.
So there were a couple things in there. The first one is a recession right around the corner. If I knew the answer to that, you and I wouldn't be talking because I'd be on Wall Street charging Warren Buffett $5,000 an hour for my time.
Right.
So I don't know if a recession's coming. I don't know any more than you, and that's the question I have for anyone that claims they can predict the future. Why are you talking to me? Why aren't you charging Warren Buffett $5,000 an hour for your advice? That's the question I always ask.
I think we can say it is coming. It's only when, right?
Sure. No. I mean, everything is cyclical. So yes, there will someday be another recession. That is true. And there will someday be another boom cycle, and there'll be another recession. And yes, that is true. It's a cycle. One thing in terms of the, how conservative or liberal lending is, lending right now is still more conservative than it ever was in the past. One difference is in 2006, you might have had a loan that looks like it's a 36% DTI, and you're like, oh, that's a really low risk loan, and all that sort of stuff. But then the problem with that is that's 36% DTI according to stated income. So what's the real DTI? You have no idea. So when we talk about 49% DTI in the current era in 2009 going into 2019 going into 2020, that's actually a real number based on really conservative underwriting principles. For example, self-employed, you generally got to be self-employed for 2 years before that income will be considered at all. And I'll give you a ridiculous example because usually ridiculous examples help us understand what's really going on. I had a doctor who had a 3-year contract for an Israeli company that was selling medical devices in the United States, and they only had a very few people in the United States doing this, so they didn't want to set up payroll and set up an HR department in the United States. So the doctor had a 3-year, $20,000 a month guaranteed income in the contract. All he has to do is keep having a pulse, and he gets $20,000 a month. There was no ambiguity in the contract. His mortgage qualified income was $0 because it just so happens that he was on a 1099 and not W-2.
Okay.
So if you're telling me that that underwriting is getting crazy, they're doing all this crazy, if that's the position you're taking, tell me why couldn't that doctor get a normal vanilla Fannie Mae 30-year fixed loan?
Right.
He should have been able to.
Right. And so the qualifying criteria, the underwriting, is much more verified now than it was in the past.
Yeah, so you might be skeptical at 49% DTI, but it's a real 49% DTI. It's not 36 on paper, but in reality it's 76 or something absurd like that.
Right. And so you don't have the liar's loans the way we used to. Are any loans available that are interest only, or is that, negative amortization is a thing of the past, I'm pretty sure. But what about interest only? Are those available at all?
Yeah, so that's what's in the non-QM bucket of loans. QM stands for qualified mortgage, which means it checks every single box you can think of, from CFPB to Dodd-Frank to all this stuff. And if it is a qualified mortgage, the lender is more protected in the case of a lawsuit. If it is a non-qualified mortgage, the way I've heard it expressed is that the lender loses the presumption of innocence. One of those boxes you have to check to be a qualified mortgage is that it has to be a fully amortizing loan with a max term of 30 years, which means what I just said. Whereas a non-qualified mortgage, they're not trying to check those boxes. They're not claiming that it's a paper type loan. So those ones can be interest only for the first 10 years, for example. Those exist.
Okay, so what you're talking about, Chris, is interesting because it's kind of the background of the mortgage business. And I think it's important for consumers to understand this. When you're saying the qualified mortgage, the QM mortgage, is where you check the boxes that it's Dodd-Frank compliant, for example. And Dodd-Frank is this 2,300-ish page bill that's extremely complicated, and Bernie Frank and Chris Dodd were the main proponents of it, and we all remember this coming out of the Great Recession mostly. And when it's a QM mortgage, you say the lender has some insurance. What you mean is when they sell that loan off into the secondary market, whether or not they're going to have a buyback risk, right? Is that what you're referring to? Not
quite. So what you're talking about is whether or not it conforms to Fannie Mae guidelines. All Fannie Mae loans are qualified mortgages. Not all qualified mortgages are Fannie Mae loans. Kind of like every square is a rectangle, but not every rectangle is a square.
Mm-hmm. Perfect. Okay.
So generally speaking, if it is a qualified mortgage, that just means that, if someone sues you or alleges predatory lending, the court's not going to start by frowning at you and thinking you're doing something shady. They're going to start by assuming you were acting in good faith, and the onus will be on potentially the person suing you to demonstrate that you were not acting in good faith, that you did this fraudulent thing, or you lied about this, or you lied about that. If it's a non-qualified mortgage, like your position in that courtroom, in the eyes of the courtroom, is going to be more disadvantageous the second you even walk in there.
Much more risky if the lender is ever pulled into court, right?
Correct.
Yeah.
So a standard QM agency mortgage example would be a Fannie Mae 30-year fixed or an FHA 3.5% down 30-year fixed, whatever the case may be. They have other loans that are not agency, they're not backed by Fannie, they're not backed by FHA, but they're still qualified mortgages. They're still terms of more than 30 years. They're still documented income. They're still, have the normal DTI restrictions and all that stuff. You just can't sell to Fannie Mae, which means you might portfolio that loan on your books. But to make things even more complicated, that exists on the non-QM side as well. There are people that will do a non-QM loan and portfolio it. Most hard money loans are examples of that. You follow?
Yep. Yeah. I'm a hard money lender, so I'm definitely not doing QM loans.
There's another bucket of non-QM loans that are the ones that you mentioned earlier are their interest-only loans. There are institutions doing these non-QM loans that have found people on Wall Street that will buy that loan. So Fannie Mae is not going to buy it, but Wall Street might.
Do you have any stats or a sense of how much of the market is qualified and how much is non-qualified?
Over 90% are going to be qualified mortgages that are actually happening.
Okay, that your sense of it is 90% or more are qualified mortgages. So that's the vast majority of the market, obviously.